Shalom, everyone. Welcome to another episode with BahtKaleb Consulting. I am Malka. Today, we are going to discuss 7 financial reports business owners should review regularly. Keep watching and watch this entire video to make sure that for your small, medium, or large business, you do have these 7 reports. Okay, let's get started. The income statement, also known as the profit and loss statement, is critical. This helps you figure out how much money should be coming in and going out of your business. From a business perspective, your net income is what you make after all expenses have been paid for. Identifying your revenue is crucial when analyzing an income statement. There's 2 ways to look at this. To begin with, start by comparing your current period to the past period. So that's very important. How is the income for the same period compared to last year? Are you trending towards what your budget was? What are you doing to achieve your plan for the year? And this is good that you're watching this video because if you didn't do it in 2025, you can get ready for 2026. Next, it's a balance sheet. A company balance sheet provides a more accurate picture of its financial health and its income statement rather than the income statement. The revenue and expenses noted on an income statement are temporary, whereas a company asset indicate its current standing. The liabilities are all the things you owe, and the equity is just like home. You look at what you owe and what's left over, and that's it. Your balance sheet. Next, covenant projections. Mhm. Every company that borrows or typically uses loans is subject to certain conditions laid out in the contract they signed with their bank. This covenant outlines how they are supposed to run their business. Lenders are more willing to lend money if they believe you will repay the debt. People would not feel confident investing their money if they do not know how you will make it back and get the return on investment, which we call a ROI. Because of this, covenants are extremely important. You want to investigate how your performance has been or is going, as the lender may cut off or go into receivership if you do not comply with the loan. Yes, covenant projections. Next, budget versus actual report. And of course, you'd be surprised how many small businesses don't do budgets. I don't know how they're lasting. If you fail to plan, you're preparing for failure. Entrepreneurs have great ideas, but it's a separate task to plan financially and ensure good returns. A budget is significant. As a result, you shall have a yearly plan that states where you're going to go this year. The difference between budget and forecast is that the latter will be updated as you go along. This report compares our budget or forecast with the actual results and analyzes where we are. If you see a significant drop in revenue from your department's budget, the first question to ask is what happened? There could be a perfectly reasonable reasons why it occurred. That has nothing to do with performance, but if you're not budgeting and running reports, you won't know. Next, accounts receivable, account payable agent report. Accounts receivable is a list of transactions you are yet to be paid. Accounts receivable refer to money that a person owes you. On the other hand, we need to pay our vendor accounts and accounts payable. These are expenses that we owe, receivable coming in, payable going out. It's common to have an agent report which tell you how long invoices have either been on the receivable or payable side. The information can be helpful in many ways. Customers who aren't paying their bills and customers with concentrated credit risk should be given greater attention. If someone is paying slowly, that's a sign. You mean you're not getting money yet and revenue isn't revenuing until we receive cash. That's not an accounting rule, that's a business rule. You need to have an agent report, or you'll be sending products to a company that's 3 months behind. Vendors should be considered partners in achieving your goal, much like how you want clients to view your business relationship. The typical business allows clients to pay for goods 30-day terms. Again, it varies by industry. You can do 30, 60, or 90. Now, if you notice that, wait a minute, this one was on a 30-day term, but it's been 60 days since they pay, that's concerning. So you need to look at that. Next, weekly performance, weekly key performance. We call this in the industry KPI. When I manage call centers, ran call centers, we call it KPI, key performance indicators. Now, KPIs are used to measure performance. As the name suggests, it should be viewed weekly. Your financial information is usually not revealed for a period of 5 to 15 days after the month ends, depending on your company. For publicly traded company, you will see 3 days after the month ends. Businesses produce many types of report internally, but management reports is your pulse on day-to-day operations. So you need KPI. You need the KPIs is functioned by each different department. Operation, typically you will see a customer service, like how quickly do they deliver their service. You have to see KPI. Do your customer service have people in hold for 10, 15, 20 minutes? Why? How efficient are your services? Accounting, a popular one is closed days. What do they have outstandings? How are they getting your payable out? How is your receivables doing? HR, employee turnover. How do you need to train more employees? Are people leaving your company? It's you need KPIs so you can see what's going on. For each department, you need to know how efficient they are. One of the things that many people hear a lot about, and I think it's a great thing when you look at KPIs, it's NPS, which is your Net Promoter Score. So feedbacks from your client. You know, I have a passion for making sure that we serve our clients well in our businesses. So that gives you good indicators because your clients are your keys. So you got to have a net promoter score. What are your customers saying? That's weekly. You need to find that out. Next, industry specific reports. Different industries require different standards, but there are typically some standards, measures, and metrics to consider. These reports may fall on their operations. So, your industry, you may have different reports, but if you watch this entire video, you will see that wow, whether you're starting small, you're a medium, or you're a large business, these are reports that you need. In addition to your industry specific reports that is required. Those 7 financial reports, they're very critical. So I always suggest that business owners look at their income statement and balance sheet first. Make sure income statement and balance sheet are the first thing you look at, and everything else you add as you go along. Praise Yahweh. Shalom, shalom. Thank you for watching.